How to choose a fund for your short-term goals. That's the topic of today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me is the CEO of Value Research, Dhirendra Kumar. Dhirendra, welcome.
Thank you.
Before I get into a deep conversation on how to choose a fund for the short-term goals, what are actually the short-term goals?
Oh, of all kind. You know, the money which you need in near term. If you want
buying a car is short-term
buying
goal?
a car, planning your holiday,
Okay.
a year down the line, 3 months down the line, the money which you know you are likely to need in recent future. And in the investment context, I would say that short term is 5 years. Anything which you know you need in a predictable manner. Then broadly the operating framework, your mental framework should be that this is anything which you need in the foreseeable future within 5 years. I would say that you need a short term strategy. Depending on the negotiability of the goal, you need money for your child's admission in a school. That is not a negotiable thing. Going on a holiday in the next 6 months to 12 months is a negotiable thing. Or even buying a house could be a negotiable goal, that you need to buy a house, and you need to buy a house in the 5 years from now. But if it is 6 year or if it is 4 year, it won't make a difference. So there are goals which are non-negotiable. Your retirement income, that is a non-negotiable goal. On one day, your job will come to an end, and you have to plan to derive income from your accumulated investments, or if you are not getting pension. So non-negotiability of your goal, negotiability of your goal, and within 5 years is short term.
All right.
And
so
that is how, and these are the primary, this is the primary input which will drive any action plan of the kind of investment that you should make for this time frame.
So how do I go about picking a fund for a short-term goal?
So split this 5 years in even smaller time frame so that you have the least possibility of getting a nasty surprise. So if you're very likely to need the money in 1 year and less, then invest in a liquid fund. You will not get a surprise. They are very well structured. Or if you need money for few days and it's a large sum of money, maybe overnight fund or liquid fund. These are the only options for you. 1 to 3 years, maybe ultra short-term bond fund. They are fixed income fund, but they increase their tenure in a manner to optimize your return. So you will get little more than. So liquid fund will get you closer to what you'll get in a deposit in a reasonably liquid manner. Advantage is that you can take your money back anytime. You will get return for all the money all the days for which your money was invested. So there is absolutely no compromise on the return, and absolute liquidity, reasonably safe. 1 to 3 years ultra short term bond fund. Then more than 3 years, maybe short duration fund. But while doing this in fixed income fund, because these are, you are not investing in such funds or making these investments to maximize your return, to have a great return, but you are just to get a little more return and making sure that your objective is met. So in that sense, exercising caution while choosing the fund. When it comes to equity, people generally chase performance. People look at performance, and they tend to chase the best performing ones. Here, chasing the best performing ones may not be the right strategy. Choosing a fund which has the least possibility of giving you a bad surprise is desirable. So these are the things. Up to 1 year liquid fund, 1 to 3 years ultra short duration funds, and beyond that short duration funds.
So what we are saying is that we have your goals divided into two.
Yeah.
Non-negotiable goal and the negotiable goal.
Yes.
Based on that, up to 5 years.
Up to 5 years, these are for your non-negotiable goals. You definitely need the money and you don't want any possibility of a surprise.
Okay.
For the negotiable goals, as I was saying, that you plan to buy your house and it could be 4 to 6 years, not necessarily a specific date. For that, for the up to 1 year liquid fund, even here. Because 1 year time frame itself gives you less negotiability. 1 to 3 years, ultra short duration fund. Beyond that, 3 to 5 years, And for a non-negotiable goal, you should try and optimize return. Maybe an equity savings fund, you will get 2-3% more return. The negotiability of a goal gives you an opportunity that you can time your exit better. One can actually get something like 10 to 15% more return by choosing this option.
Okay. How are these funds on the tax front? Do you have to pay taxes on the short term?
Yeah, taxes are also non-negotiable. Death and taxes, the famous quote people refer to.
Yes.
But they compared to what is the key thing, and compared to all other fixed income yielding instruments, mutual fund turn out to be little tax efficient. One is that if you invest in a mutual fund, you don't owe any taxes till you realize the gains. Okay. And up to 3 years, there's not a significant advantage, because whatever be the income, whatever be the gain will be added to your income, and you'll be taxed at the marginal tax rate you fall into.
Okay.
So if you are in the zero tax bracket, and even this income from your investment is also not making you liable for taxes, it will be zero tax, or 10% or 20% or 30%, depending on your overall scale of income. Holding for more than 3 years, it becomes very attractive, because then the nature of the return from fixed income fund is like that of an interest. The way you make a deposit is the way you buy a bond fund, which in turn makes a deposit kind of investments and gets you similar kind of return, or maybe little more. But by virtue of holding this mutual fund, it becomes a capital asset. It becomes a capital asset, so you are liable for capital gains. Capital gains is lower than your tax rate, and capital gains also gets you the privilege of indexing your income, indexing your gains. So whatever be the return, it will be reduced by the inflation, and whatever be the inflation, and post-inflation, inflation adjusted return. So only that much is liable. So the tax rate becomes substantially lower. So for 3-year holdings and more, fixed income funds turn out to be very tax efficient.
Most of these funds are actually in the debt category, which have witnessed quite a turmoil at this point of time. So how should one go about picking these funds in the recommended categories that you just mentioned?
First and foremost, don't chase the best performing fixed income fund. That could be risky, that could be dangerous. So normally fixed income funds earlier, or so far before the risk actually visited most Indian investors last year, chasing the best performing fund was a good strategy. No longer. If there is a high return, there is bound to be some risk, and risk has tendency to come out nowadays more often. So that's one. The other is that look at Value Research website. You will go to that fund page. Every fund is covered with a dedicated page to it. Look at the portfolio section and look at the credit rating of the portfolio. Err on the side of caution. Choose few good funds and based on return, and look at the rating breakup. If it is substantially into lower rated papers, it's a risky bet. Whatever be the worth, there are a lot of questions being raised about the worth of credit rating or how useful it is. But whatever it be, even if it's a relative measure, even if it is an inaccurate measure, it is a measure. And just because it's a measure and it is a regulatory compulsion for people to have, rating itself sometimes becomes a risk, in a sense that if rating changes, a lower rated paper, a small decline will cause a difference in the marketplace on the worthiness of that credit or that bond. So look at the rating. Avoid funds with too much in lower rated papers.
Okay.
And third thing which one should look at is that if the fund has huge positions, if the fund is too concentrated, large positions in few bonds, that is avoidable. So except for the government bonds, ignore the government bond, but make sure that no security is more than 2-3%. It is, and that I would say that is fairly diversified, because 2% even in any bond will make sure that the worst case scenario is that 1 or 2 bonds default. It will be 2% of your total portfolio. So mutual fund by design itself actually extend you great safety, reasonable security. But these are the precautions. If you take, it will be nice.
Okay, and important how important is diversification in long term and short term? How diversified should you be to achieve the short term goal or a long term goal?
No, they are to be clearly segregated. The money which you don't need for 5 years and more should be in equity or in kind of equity dominated investment, whether it be a balanced fund or a aggressive hybrid fund or a conservative hybrid fund. But when your long-term goals get closer in the vicinity in terms of you need it has become a short-term goal. Then you need to plan it like this.
Long-term becomes short.
Long-term, you were you had planned your retirement savings and you started in saving at the age of 30, and now you are retiring. So if you are going to retire in next 2 years, maybe you need to prepare for the money which you are likely to need in next 1 year. That money should be in liquid fund, the money which you are likely to need. So move your money from your long-term allocation, what was your long-term accumulation, for short-term savings, for short-term goals. So you need to do that proactive shifting.
All right. So this is what Dhiren has to say about the short-term goals and how to go about investing in them. And we now move on to the Q&A part of our program. The first question is from Aditya Rathi, and he says, I have 25 lakhs which I want to use for buying a house after 3 to 5 years. Where should I park this money? Currently, it is a mixture of liquid funds and FD.
I would say that 3 to 5 years, one can short duration funds and a relatively safer. Exercise all the checks which I was referring to in the previous part of this discussion. So, ultra short-term bond fund could be a desirable way, and 3 to 5 years. I was telling you the advantage of investing in a mutual fund is that if it is little more than 3 years, your return will be indexed, so you will be liable for much lower tax as compared to FD. As compared to FD, you are also likely to get higher return, and but at the same time, don't try to maximize your return for this time frame.
And while we were discussing
and don't even consider any equity.
Yeah. Okay. While we were discussing about where one should invest for short-term goals, more often than not, people think that FD is actually थोड़े समय के लिए ना तो 1 साल के लिए FD कर लेते हैं, which you just answered that this is not a very smart way to invest for short-term goals, because you end up paying taxes for them.
Yeah, in terms of, but the home buyers, everybody has a bank account. And they're, today online, doing a fixed deposit online is just few clicks away. Then the trust factor or understanding, it's a historic thing. We have seen that, ever since the financialization or in the family, fixed deposit has been the way to park money for gentlemen. So, everybody understands it. Also the predictability of it. The big difference between a mutual fund and a FD is, and the charm of FD is, that you know exactly how much will you earn. Here you don't know how much will you earn, even though it is tax efficient and very likely it is going to be little higher. But you don't know whether you'll earn 7.25%. When you do a deposit, you know that this will get you 7.25%, and for senior citizen it will be 7.75%. It will be compounded every quarterly. You can take your money out anytime. If you want to borrow against your FD, you can do it. Just walk into the bank. So the comfort comfort and understandably so. So one should have a deposit, but in a defined way. Rest of your long-term or medium-term or short-term fixed income allocation, because you don't want to take risks, so you want to invest in fixed income. Understand that what is the compromise? Compromise is lack of guarantee. What is the payoff? Tax efficiency and slightly higher return.
Akash Agarwal writes in and he says that how many debt funds should I have in my portfolio?
I think, of the appropriate kind, depends. If you have some money which you need in next 1 year, you should have 1 or 2 liquid fund. If you have some money which you need in 1 to 3 years time frame, you should have an ultra short-term bond fund or 1 or 2. But in each of these segments, you should not have more than 2, because I don't think there are more than 2 great options. Spend your time looking for the best one. One will be good enough. But I think choosing the appropriate kind for your defined time frame is critical. And so I think, depending on this, you should have not more than 1 or 2 for each kind. So at most, if you have some money which is needed within 1 year, 1 to 3 years, and 3 to 5 years, 6 funds and no more.
And for the uninitiated, Dhiren, where should they get this information?
Oh, all this information is there on Value Research Online. You can also, very soon you will have a mechanism whereby Value Research mutual fund analyst will give you a curated list of good funds for you to invest, and it will try to fulfill the needs of such investors who have been following the advice, but they really don't lack the ability to look at the specific one, or they'll just look at the return, or they'll just look at the rating. Moving beyond that, a curated list of things to buy for each of these simple goals for individual investors will be available shortly.
That's going to be a big boost for the investors. All right, Anand Kumar writes and says that I am retired. I have 50 lakhs of rupees with me. Where should I invest the amount? My need is up to between 30 to 35,000 per month.
I would say that Anand should be investing a little carefully. This is very important money, and it needs to be supported by an income which also should be, which should get revised every year in line with inflation. So this is good enough money to support the income expectation that you have. I would suggest that, to begin with, keep your 3.6 lakh rupees, the money which you need in the next 1 year, into a liquid fund, and implement give a standing instruction for a withdrawal of 30,000 rupees every month. So 3.6 lakh rupees which you invest in a liquid fund will come back to you over the next 12 months. And the remaining money of the 50 lakh rupees, so 46.4 lakh rupees, that should be invested in a conservative equity income fund, and spread that money over the next 18 months or 20 months, 18 months or 24 or 2 years. You will be able to average your investment, and from there, every year take out 3.6 lakh rupees or 7% of whatever be the accumulated value, because every year your capital will keep growing. That particular investment that you have spread over the next 12 to 18 months or 2 years will keep rising, hopefully. And and if it doesn't rise, settle with lower return, settle with as much return, just take out only 7%. Of whatever be the residual value. And I think following this simple plan will make sure that his income will keep getting revised, and his capital will not get substantially impaired in the interim, and he will have rising income and his capital will accumulate to a much larger or modestly larger amount steadily over a period of time during his retirement, and he will eliminate the possibility of outliving his savings in his outliving his savings, which is very important.
Okay. And then more often than not we get as to where we should invest our money, but here's this question from Raghav, and he says that please tell me, how should I exit from the mutual fund scheme?
Primarily, you should exit from a mutual fund for internal reason. Internal meaning, reasons which are with you. And the external reasons are also 1 or 2. One is that, internal reason is that you have met your goal, take your money out. You are saving for a certain goal. You are saving for a certain goal, and now your goal has changed. You are investing for accumulation, and now that has become a short-term goal. In next 1 year's time frame, you will be needing the money for your child's education. He's getting into college, so now you need to change. So these are internal things. On those reasons, you should definitely exit. External reason, what happens to a fund? You chose a fund because the fund was doing very well compared to all other funds consistently over a period of time, and it has stopped doing so. Sell your fund. But what is the time frame that you should allow this fund to prove to decide conclusively that yes, it has stopped doing well, and you should give up? I think it depends. If it has been a relatively new fund, 1 year is good enough period. If it is managed by a very old fund, a fund has done exceptionally well over the last 10, 12, 15, 20 years, and it has not done well in the last 1 year. It has not done, so don't give up. I would say that, there could be a situation when a great fund is not doing well, but it can well reward you with all the kind of experience or richness, or, don't write off more credible history. So, I have, there was an instance where a fund manager had a long history of 20-25 years, and we gave it up to 3 years to do well. And in the interim, from value research, we were getting back to the fund manager to understand that how he thinks, what does he think, why is he not doing well. And the rationale looked very convincing, but then eventually it did not do well, and we gave up. So we allowed 3.5 years to a fund manager, but many a times you may not have the luxury of that much time. So it's external reason, internal reason. Internal reasons are non-negotiable. You should make that call. And other one more reason which actually makes me think, and many a times it warrants an exit from a fund, is when a fund manager leaves, I'm alerted. But if I'm ever faced with a situation that potentially, a credibility issue, a trust issue arises in a fund company or a fund, then I think it is, you don't have to turn back. Take your money and never look in that direction again. So that is something, because this is it's a trust business, and if there is anything which is not smelling good,
a breach of trust,
smell of that. It may not be a violation of the law. It may not, but something which looks like being done not in the best of my interest. I think that's time to walk out forever.
So for all this, and to to get to know whether the trust is breached or not, keep your eyes and ears open, read. And
we'll be talking about on value research online all the time, and some of these things will actually crop up. Any such thing actually comes on the surface very quickly.
Okay. Ajay Rungta has written to us asking, are NFOs worth investing?
Mostly not. Because
as simple as that.
Yeah, mostly not, because funds are in the business of launching a fund, and they have to launch a fund. Then only they can build a history. But for investors, the choice is that they have the luxury of choosing a fund which has some credible history. So you understand, all there to you don't know which is a great fund till you invest your money, and after that it does well. But the best way of looking, evaluating a fund is that the only thing which you can evaluate in a fund is that how it has done in a good market and how it has done in a bad market. And you don't know anything about a new fund. In some cases, exceptional situations, some NFOs might be worth investing if there is a new category of fund which is coming. So, and you think that the case is very compelling. For example, recently, few months back, we had a situation that real estate investment trust came into being. And it was an NFO. It was for the first time. And if you think that the case is very compelling, worth considering. But generally speaking, NFOs are not worth evaluating.
Abhishek Mukherjee has written that I have 2 properties and I recently sold one of them. The other one is on loan, but the money that I have received from the sale of the first property is sufficient enough to pay the loan of the second one. Should I continue with the loan to avail tax benefit or pay it off with the surplus?
I would say that, generally, home loan is the only loan worth carrying on for a variety of reasons. One is that it's a long-term loan, and if it fits into your income framework, if you are not stressed in repaying the EMI of the loan that you are carrying, it's worthwhile. Then, and it's a long-term loan, so if there's a great predictability and you have a rising income, then it becomes a very nominal part of your income outflow. The other is that, for such long-term loan, you get fairly concessional interest rate. As compared to that, long-term equity investment can get you more return. So it is better to carry that loan. Third is that, if you are, you get a tax break. on the interest and the interest repayment of that loan. So all these three combined together, home loan is worth carrying on. But in one situation, you should actually repay the loan. If your income, if you are actually getting stressed in repayment of the loan for your day-to-day expenses, then understandably one should actually reduce the debt.
Akash Agarwal writes and says that by mistake I invested in a regular plan instead of direct plan of an equity mutual fund. Should I switch now to the direct plan or wait for 1 year to avoid exit load?
Look at what the exit load will be. And I think it is generally avoidable to pay the exit load because it ranges between 1 to 2%. So should be worthwhile but you will save the 1% and 1% could be the higher expense. That is one, but more importantly, look at if you are sitting on gains, the gains will be taxed at 15%. But today there is no escaping even the long-term gains, which will be taxed at 10%. So the differential is not much. So just do this little basic mathematical exercise and see what is the potential gain and loss on the exit load. Exit load is one thing. Short-term or long-term capital gains is another thing. Calculate both and then make the choice. If you are doing a SIP, cancel your SIP and make your future SIP in the direct plan and let this money lie there and let it become 1 year older and then take the action.
Yeah. Why get into the exit load? Right. K.S. Gandhi says that what percentage of the corpus can safely be withdrawn from the systematic withdrawal plan without impacting the principal over a period of 5 to 10 years?
Depends, because if you are making investment in an equity fund, the systematic withdrawal plan, because the underlying is very volatile. If you are investing in an aggressive hybrid fund, it will be relatively stable than an equity fund, but it will still be volatile. If you are investing in a conservative hybrid fund, then it will be, the returns will be lower, but you will have to. So the withdrawal is entirely a function of the asset you are investing in. I would say that depending on that, what percentage depends on the kind of assets that you are investing. I would say that if you are investing in a balanced fund, aggressive hybrid fund, then maybe a withdrawal rate of 6 to 7% is good enough to support inflation adjusted rising income requirement. If you are investing in a conservative equity income fund, which is a third or 20 to 35% into fixed income, remaining equity and remaining in fixed income, then I think you should never think in terms of more than 5.5%, and then depending on the future performance, revise it periodically. So 5 to 7.5% should be the withdrawal rate.
Okay. Well, that's all we have in today's program. Dhiren, thank you so much for your time. Till we meet next time, continue to invest regularly. Bye from Dhirendra and me, Rajesh.